Monday, August 4th. Welcome back to the Daily Rip Live. I'm Katy Perry here with Shay Boloor, as always, and we have a super special guest today. Welcome, Steve Hou. Steve, quantitative researcher at Bloomberg, and you basically hunt for what works in the markets. And also a new friend of mine on X. Steve, thank you for hopping on. We're so excited to have you here today.
Thank you so much for having me, guys.
Before
Big
we get
fan.
into it, let's get into. I know you got something funny in your Twitter bio. Chamath had something to say. What is that? What did he say about you?
So yeah, I'm fairly active on Twitter, and I think so. This was kind of random. I think Chimat was taking a victory lap a few weeks ago about a trade he had proposed at the beginning of the year, and he was talking about how he was proposing was short Mac 7 and long the rest of the S&P 500. I think he sees it must be something along the lines of like them increasing capex and therefore becoming less attractive investments. In any event, if you take a look at the cumulative return of that strategy, it ended up yielding about 2% in the long short return. So I kind of teased them a little bit. I just did a bit of a quick math and saying like basically if you annualize the return of that strategy, it's basically worse than if you had just bought T-bills. And then the thing is, what really blew it up was when I woke up the next day not thinking that it was not going to gain much attraction because it was not, right? And he replied to my post saying that it was an incredibly unsophisticated
Okay.
take because the right way to do it is to have an Easter, right?
Hmm.
And lever it up because that's apparently how sophisticated investors would do it. So I think that basically was what blew up the whole thing. And
Right.
I replied to him saying basically that if this was supposed to be a recommendation to his millions of all-in listeners, that maybe wouldn't presume that everyone already have an Easter to implement the strategy as such. So that was
Love
fun,
it.
and I took great pride in being called incredibly unsophisticated, which I think I am.
Yeah. Thank you for the tagline. I would say that's great, and you get more eyeballs. Shai, do you have any public beef with anyone like that you would put
Oh,
in your bio?
I
Who's
mean,
on the list of enemies?
I think we all know. I won't say the person's name,
Oh,
but I think we all we all know that person.
Uh-huh.
I need someone. So someone on my Instagram this weekend, like people comment on my post because they think I'm the singer. And someone's like, went back on a
Oh, you
post and
must get that all the time.
yeah. They're like, when are you gonna stop killing nuns? And I'm just like, that's just like a weird thing. I'm just like walking down the street and it pops up. But
I won't
um
question your hobbies. Don't question mine.
I know. I'm like, all right, back off, like Max 17.9 from wherever you're from. But I'm glad we're all here today. I actually had a nightmare last night that I missed this show. So it was
Ah.
I've lived this episode. It was horrifying. So I don't know why I missed it, but I was like watching it on my phone. So I'm glad we're here. There's a lot of news to discuss. Obviously, we had the jobs numbers, the revisions from last week, the Dow dropping more than 500 points. We had our worst day in the Nasdaq or in the S&P since May. A lot of drama there. The removal of the BLS's head statistician. We had earnings last week. We have more earnings this week. Let's dive into some of the headlines from today, and I also want to do a few things. One, go through sort of what the headlines are for today as we get into the week. Earnings preview, and then Steve, I want to zoom out a bit because I know you have some really interesting approaches that you use when looking at this data, and I think our listeners could really benefit from hearing how you think about those things. Let's kick off though with the big news out of Tesla this morning. Tesla handing Elon Musk a $26 billion stock package. This happening without the shareholder vote. So it's replacing his 2018 pay deal, which a judge threw out last year. And so instead of performance milestones, this only requires him to stay there for 2 years. All he has to do is stay put. So it's 96 million shares at $23 each. So that what's that? A little over 10% of his total net worth would be what that's worth. Guys, was this? I actually didn't know this news was potentially happening. I remember we haven't talked about this pay package in a bit. Shai, is this you're a Tesla investor in the weeds? Is this something that you were expecting to hear about today, or does this come out of nowhere?
I mean, the board of directors at Tesla aren't idiots. So, like they know that there's an Elon premium assigned to any company he's part of. So I knew this was somewhat of an overhang for I think it's been a while now. Unfortunately, this was just a drizzle compared to the storm that Tesla's experienced this year, so it just took a back seat. But it is one less overhang now on the Tesla stocks. That's why you're seeing it catch a 2.5% bid. I'm happy to see it. I think you guys heard me talking about you need four things to be a winner in this new digital economy: the data, hardware, distribution, and next gen brain. I almost want to add the fifth thing: you need the captain to run that
Mm.
ship. And I think that Elon is going Elon is one of the best captains out there. And if Tesla truly becomes that physical AI leader, you need him guiding the ship. And that's also like why they still don't have the next gen AI brain part yet. They will once they merge with XAI if they ever do so. But if they when they do, they have all 5 of 5. So happy to see it. It's a I know we were probably gonna see a lot of headlines like, oh, it's so much money, like stock has gone in for 4 or 5 years.
Well, he has also really earned it, hasn't he?
Yeah, he has. He completely has earned it. Especially he was kind of semi promised this, and some douche in Delaware said, no, 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 I don't believe in this anymore. So I'm happy got recorrected.
Steve, what are your thoughts here? I was just scrolling back at some of your past posts on Tesla, and we talk a lot on the show about just going from EV to AV and the
Yeah.
autonomous future. How do you? It sounds like you think he's doing a pretty good job towards that future. What's your take on Tesla at the moment and the direction they're headed in?
So I'm a quant, so I don't focus normally on individual stocks, but I am personally a big fan of Tesla. I own a Model Y. It's my second Model Y now. It's definitely my favorite purchase. I use FSD, drives me everywhere. Early last year, in the spring, I first subscribed to FSD because of the version 12 and hearing about, I thought I will test it out. And I thought maybe that could become a catalyst for the stock doing well. And I bought the stock and subscribed to FSD. The stock ripped for completely the wrong different reason, right? It was because of Trump, right? Elon embraced Trump and Trump won, and then the stock almost doubled, post-election with, of course, then, sort of comes and goes. Generally, I think Tesla and Elon is obviously a historically unique personality. I don't think there's been anyone quite like him for a very, very long time. And Tesla is very uniquely positioned, right? Being multi-thematic, straddling across autonomous driving, electric vehicle, AI, and you've got Shay mentioning, sorry if I'm butchering your name, that Elon, you really need this kind of I think someone was talking about founders mode, right? You need someone who's actually at captain of the ship, leading the company forward with a vision at a time of historical inflection, really. So I think it's one of those things where like it or love it or hate it, you cannot take eyes away from Tesla. I think recently an interesting data point: China, which is basically the second big, maybe the biggest market for electric vehicles, and certainly the second biggest market for consumption, recently did a big study of all autonomous driving vehicles, including Tesla and domestic brands. They wanted to sort of test out, right? And this was done between a very popular online car reviewer and the state television, and Tesla came way ahead, like by far the number one, sort of beating all benchmarks. And the domestic car brands, a lot of them face planted. Then the state TV tried to walk it back and minimize the coverage, which I thought is an interesting data point, validating, I think, the strength of Tesla's AI.
Yeah, we had some.
I,
Go ahead, Shay.
I also want to add like that founder mode is so freaking important. I have this like hot take that if Sergey was still running Google, they would be top 3 company in the world right now. And this narrative of AI cannibalizing search would be far less than it is right now. Is because like what their CEO right now is such an operator. He's not a showman. So like they're doing all the great things behind the scenes, but that narrative is like literally half the equation in this market, clearly. So I think that web browsers are for sure dead. You're seeing signs of that. It's going to be all AI browsers, agentic browsers, etc. Every LLM will have its own browser eventually. You're going to see that. There's no reason why Google shouldn't have been the first to just do that right off the gate. Rip the band-aid off ASAP, be the first one to do it and own that space. But again, like there's a different level of risk that CEO is willing to take if they're a founder. And that's why the founder mode is so important, because it's part ego, because you freaking created this. This is your brand that you want to make sure it never dies off. First, you have a lot of sweat equity via comp. It's very different than pride equity. And I think that that's why you need a founder-led CEO.
Yeah, I think from a different angle also, some of these, we are living through this period when the last decade was a very different macro regime than this one, right? You suddenly coming out of COVID, you exited this sort of slow kind of, uneventful decade, low interest rate, low inflation, not a lot of macro volatility, not a lot of like huge tech innovation as much as what we are seeing now. And suddenly I think you're at this point of watershed moment where there is so much macro, geopolitical, and technological, disruptive risks that, whereas previous decade you could have comfortably delegated some of the responsibility to regions and professional managers who will steady the ship. Today, you really, I think, you are in big waves now, and having that, I think, founder status probably gives the company the ability to take strategic vision, sort of. Decisions that may or may not be right, exposed, but it's probably what's necessary to navigate through this period.
Well, one of the biggest knocks I get for myself is like when I go on TV or do the analysis is, you're only 32 years old. What else, like, how do you know, like, why would you know this much? What's your wisdom? Even if I was 42, what happened 20 years ago that didn't happen past 5 years? Not much. The cloud was like a mini cycle, it wasn't a super cycle on the tech front. But like what Steve's saying, like, it not much happened from like 2010 to 2020, to be honest. Like, not much happened in those 10 years. Like, yes, probably some little blimps, but even if I was who I am today back then, I don't know if I'd be as excited, because it would just be more about margin expansion, fundamentally driven markets, see hot pockets. There was no super cycle during that decade. Right now, we have 4 super cycles: space, quantum, AI, electrification. Like, it's happening all at the same time. It's way more like intense. So like, I just want to add that color. Like, don't knock someone based on their age, because guess what? 20 years ago, nothing really happened for a decade, and now everything's happening at once.
Well, Steve, you brought up something interesting in that it almost seems like before all of these super cycles, as Shay called out, sort of converged, it was almost more astute as a leader to be more conservative. And now it seems like you guys are saying it's almost a risk not to be bold in your vision and to make moves. It's almost a risk to play almost like a Google on defense a little bit, you could argue, compared to some of the others. Do you think that's true of today, Shay? Like, it's you can't just sit back and wait for the world to come to you. You have to look at what's happening and put your stake in the ground.
Well, I think there has never been a time where there's a tsunami coming for every company potentially. That AI tsunami is coming for so many different companies in the tech space. And also, these are one of the levers you can pull in a lot of these dinosaur industries. No, a lot of people aren't talking about manufacturing, industrial, how they can finally see a renaissance of margin expansion now due to physical AI. Don't have to pay for workforce or all these machines working on these people working from a 9 to 5. Now they can work 24/7, autonomous, much lower price. Like, they get a tailwind. Nobody really talks about like John Deere's out there, for example. But this AI tsunami that's coming, like, it's going to cannibalize 75% of the SaaS companies. A reference that we use at Freetrum all the time is like, if you're a SaaS company, it's like building the nicest house in the worst neighborhood right now. Nobody wants to be a SaaS company in software, because they know it is limiting your cap ceiling, and they know that tsunami is coming for you, because these bigger players like Google, Salesforce, ServiceNow, all these hyperscalers, large cap, they can create 70% of your software product now in-house. And as a customer, that's going to be good enough, because you want to keep it all in one vendor. And if you're a bigger player, you want to keep everything in-house to control the cost. So what do you do if you're a middleware company? You're screwed unless you pivot and make a big time decision on how to become that agentic web platform or agentic platform, and just like use it as a tailwind somehow to survive. But I'm telling you, 75% of companies won't. But to answer your question, the reason like CEOs have to be more bold now is because there's a cannibalization risk now associated to your company. And if you don't communicate how you're gonna have this lifeboat to survive the tsunami, your stock will get their premium multiple removed most likely, and now you're gonna have to fight to get back to the narrative that you lost, and that pivot or that bounce on trying to fight that narrative might not ever happen, and you might just get sold out to a PE firm.
Yeah. Well, we're talking about AI. Let's jump to the jobs data from Friday because we didn't have the show Friday and we couldn't talk about this. But latest economic data showing some signs of weakness, job growth dipping. There was 73,000 jobs added in July. A lot of the underpinning of that is it's a lot of social services, a lot of nursing. Certain pockets are kind of carrying everything else, and then alongside that, you have the companies that are benefiting the most from AI cutting jobs. And so it's a weird dichotomy right now. And I think I saw a post from Callie Cox mentioning that robots are sort of carrying the economy, which is a weird dynamic. You have companies doing very well financially, and then you have this jobs data. Steve, when you saw these revisions on Friday and the commentary around it, and we'll get into the firing of the BLS chief, what do you make of that? What did you make of the data when you saw it, and did it line up with things you're sort of picking up in your world?
To be honest, so in my previous life, I'm actually trained as a macroeconomist. Got my PhD in economics in 2018 from Michigan. So I'm not surprised by the revisions at all. Like the revisions, I think, basically continues to tell a story that we already knew prior, was that the U.S. economy has been slowing steadily and but not breaking. If you track the ADP payroll, for example, it's actually been trending this way for the whole time, and NFP numbers have just been sort of hovering around, this trend back and forth. So, in fact, if I can show you, something that here, right? Can you guys see this?
Mm-hmm.
Yep.
Yeah, you see how since 2022, I show four lines here, right? I show 3 lines are basically job growth. Non-farm payroll, total payroll includes government jobs. Non-farm private payroll is only just private sector. Those the green and the red lines, those are after revision numbers, right? And you see how it travels basically alongside of the ADP payroll, which is the private payroll software company that produces its own estimation of job growth. And for the longest time, everyone's like, oh, ADP is not accurate. It does not align well NFP and so on and so forth. But after all the revisions are done, they're basically lining up perfectly, aren't they? So, this is not, I think, this should not be a surprise to us.
Yeah, and historical context, just because you've obviously studied this in depth,
Yeah.
how often are revisions this dramatic? How often does that happen where you go back and you're looking like, oh, never mind? Is that pretty rare, or does that happen a lot?
I think it happens actually a lot. If you plot the historical size of the revision, well, within range. I mean, like it's certainly big, but then it has to happen around economic inflections when, economies, slowing down, entering recession, or accelerating. But even more than that, I think since COVID, we have had a lot of issues with, this idea of birth-death modeling. Basically, if you think about like it's always sort of people casually think, oh, you just counted the number of jobs. How hard is that? But it turns out, companies that are newly established or companies that go bankrupt, how do you account for those jobs? It's easy to keep a tally of the number of jobs growing for all the companies that are already there, right? And they just send you a number of this is how many people were employed, right now. So the birth death of companies, requires modeling, and that's actually enters a lot of the inaccuracy which we are then seeing the revisions.
So it's interesting because there was a very sharp, obviously, reaction from the White House. I think we're getting the new person named sometime this week. Steve, contextually, like historically, how often are these people removed and immediately following a report? Has that ever happened before?
I've never heard of anything like that. I'm not 100% certain that it is going to happen.
Yeah.
I think a valid criticism could be made. that maybe the NFP, numbers as with most government produced macro numbers are not being produced with the latest possible, technology and ways in
Mm.
which it can be made more efficient. But I don't know. This person, I have never heard of her before. I'm not sure most of us has ever heard of her before. Just suddenly, because she
Yeah,
probably has
she's the
nothing to
main
do.
character.
She probably has nothing to do with these numbers, which are just all, being produced and released on an automated fashion. And out of nowhere, she's finding out that she's maybe out of a job. So yeah, it's certainly we're in the
Strange.
new era now.
Yeah, strange
Well,
times.
you know how it happened. Trump's like, I need a head on a stick, and someone's like, all right, let's just put this name down. That's literally what happened.
Just going about her day. I mean, I'm not saying that's a cushy job, but it's a job. You're not in the headlines a lot. You're not in, the post or anything. You're just
She's like,
chilling.
what do I
and-
do?
Yeah, one day. And also, I think about the layers and layers of people who worked on this data. They're all like, "Whoa, I missed that one." Like,
But 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 it was the world's worst secret that this data is always going to be like heavily on the upside, and it's going to get revised on the downside. And I think that I was a little shocked on Friday that the market actually reacted that poorly to it, because it was like, you guys knew there was going to be negative revisions. But I also not surprised we're catching a bid this morning, because it does reaccelerate the odds of a September rate cut. And I think that is like all the market cares about. And I think that's uh, right now, anecdotally, we know that corporate jobs are not being added. It's actually a really hard place to get a white collar job. That first wave of AI is going to be removing all the old jobs in pre AI world before we start hiring for the post AI world. That first wave is going to look like very aggressive on the FTE counts. That combined with the blue collar jobs, I mean, inflation is really high. The cost of goods is very high still. And that ROI, the P&L is looking uglier and uglier by the year. So like, why would there be an increase in jobs there? Like, it's an ugly place to be in right now, and it feels like the recession is just being masked by these ridiculous prints that get revised 2 months later, and the news cycle is so aggressive that people are like, okay. And rather than, if that was the number they reported that morning of, it would be a much greater impact on the actual like decision making of if this is bad or good.
yeah, you mentioned potential rate cut. I think I looked at Polymarket this morning. The odds of a cut in September are up to 71%.
It doubled after Friday's print.
Wow.
Like, it went from
Okay.
30 to 70, I think. Yeah.
Yeah, I think at
So,
one point it's priced at 88%, right? And
wow.
um, the, the thing is, I've always so I at the start of the year I made a pretty aggressive prediction uh, that let's see if it's actually coming through. Thought there is a very strong chance that we will have a full repeat of the dot-com bubble. Um, and the dot-com bubble, I don't know if people actually remember, the Fed similarly basically cut rates, paused, and then hiked again
Oh.
when inflation started going back up. And so actually, let me show you this a chart. What we sort of take a look at here.
But by the way, he's doing that, I
Yeah.
believe that, because like, I don't think there's gonna be 7 rate cuts next year. I think there's going to be the deflationary environment from AI, and that's gonna cause, like, we can't cut rates this much. But go on, Steve. Sorry.
So if you look at this chart, right, this is from 1998 through 2001. The full cycle, and depending on where we think we are, maybe one might find an analogy. And it's interesting that the Fed cut 3-4 times, right, going into 1999, and then paused, and then eventually started hiking again when inflation started rising. And look at what happens to the Nasdaq, though. The market went crazy. In other words, like, I actually have been saying that a defensive Fed may actually provide a catalyst, not a sort of hawkish, just defensive in the sense of they have not been cutting, they've been cautious, and that could actually be a catalyst for the market to go substantially higher. If you went with this analogy.
Well, the reason for that as well is the market is always forward looking. Like, oh, the rate cuts are coming. Rate cuts are coming. Like, we're gonna catch a bid in the market, and usually those like rate cuts are going to be sell the news events anyway. So like, them kicking the can down the road essentially provides a high floor in the market pullback in a way, because they know the rate cuts are coming. There's gonna be some kind of tailwind So it's going to catch a bit until the actual news event. But I mean, what Steve's saying, like, I don't think what's the urgency besides the job market right now on the Fed cutting rates? Like, not much. And the job market, it's the worst kept secret that it's going to be a deflationary environment for these enterprises going forward from AI. Like their productivity boom combined with the amount of FTEs that you need to do is going to be unlike we've ever seen in mankind history. And that's going to be deflationary. Like the industrial space, the consumer space, it's going to cost less to produce these materials for these goods. It's going to cause consumer prices to go lower now because of that. It's going to be deflationary. So if you go the world is changing so quickly that I can see what Steve's saying, that it's going to revert back to maybe towards the mean, which is like four cuts. But after then, I think it's going to be a prolonged pause of seeing where things are heading because these are moving very quickly.
Now you're playing the game too of, trying to time it right with also the political pressure of wanting to keep your spot where you're at to be able to do the things
totally
you think
political.
are right.
I think Pal's playing totally political right now, and that's fine. But like, I think it's unfortunate variable in this in the calculus of rate cuts.
Yep.
Well, let's.
Go ahead, Steve.
No, I was just gonna say for now, I think sort of the fundamental macro picture remains mostly favorable for risk assets, right? We continue to have essentially a slowing of the U.S. economy, slower wage growth and slower job creation, which puts a cap on services, which is 2/3 of the CPI basket. And within services, 2/3 is rent, and rent inflation famously follows wage growth. So if people are earning not as much and the job market is softening, that puts a lid on rent inflation, which people hopefully have seen in their own, rents. I think that's, for now, more than anything, what's actually keeping a lid on inflation, even as goods inflation starts to rise with some of the tariff being sort of passed through. But the overall inflation seems to be, in control.
Yeah, we'll certainly hear some commentary on these macro factors in the earnings week ahead. We have a lot of companies reporting, and just looking at the list, Shai, there's a lot of companies here that you bring up a lot. So I feel like this is a big week for you. We got Palantir today. We got HIMS, which I know you're not in, but we talk about them a lot. Axon. On Tuesday, we've got AMD. We've got Lucid. We got Pfizer. We got Rivian. Open Door, which has obviously been in the news as a meme stock. Wednesday, we've got Disney, Uber, Shopify, just a whole host of things. Let's start with the beginning of the week, though, and the one that I mentioned at the top, Palantir. Been on a blitz in terms of revenue growth. Obviously, they have, to your point, Shai, an enigmatic, bold CEO in Alex Karp. What are you looking at from their readout today after the closing bell?
Yeah, I mean, I have 35% of my portfolio reporting today. I have Mercado Libre, Axon, and Palantir, and Navitas. So very busy day this afternoon for me. But for Palantir, to start there, I just want to get ahead of it. Valuation is extreme. I'm not gonna deny that. I think that's always been the only hole in the Palantir story, has been that valuation. But spoiler alert, it's been that hole since it's been the 20s. And what's that right now? Like 150. So it's always going to be an issue. But that AI tsunami I've always talked about, like they have one of the few lifeboats out there in that stage 2 AI place. So because of that, the market's willing to assign a very premium valuation to that stock. So I think that you shouldn't look at Palantir's earnings in the lens of valuation because you're going to miss the bigger picture. You're seeing all this money being spent on LLMs out there. Every hyperscaler, every private company. Well, how do you make the LLMs correlate in the real world? It's through the decision engine of Palantir's, and that's the only way to do so. So if these LLMs actually work and going to be useful, you need Palantir, and that's why it's such an expensive add-on, but it's a necessary add-on. So I think they're becoming this command layer now for a lot of these enterprises on the commercial front, but we cannot ignore the government front of what Palantir is doing, has been doing for the past decade via like these militaries, federal agencies, defense contractors. You just saw last week, they got a $10 billion army contract is a great example of their government presence where, yes, $10 billion sounds super high, but remember, we're talking about a $300 billion company. It's not too ridiculous. But I think it was more, if you look under the hood of that $10 billion contract, what it meant, or the semantic layer, sentiment layer of that contract, where it was Palantir was assigned to re-architect all of the U.S. military's AI deployment strategy. So that means is, I think it was 70 or 75 contracts, consolidating that into one unified system so the costs get lower. Again, that is screaming standardization. And that is exactly what the Palantir mode has been. Streamlining operational inefficiencies and becoming the operating system of AI through standardization. And I think that the infrastructure is working, and it's one of those tailwinds where, or one of those themes where it feels like it's like unlimited runway, because AI is technically, in my opinion, an indefinite demand. It's not going to be a product launch like and then you're going to have to like move on to latest and greatest. It's truly a characteristic change that the whole world will start to experience forever. It's providing intelligence, and when knowing that AI is intelligence, it's not a product, that when you're the OS of AI, it's almost the ceiling is constantly get higher and higher due to the indefinite demand. So like, yes, Palantir is super expensive. I get that. I've been in it for years. I sold half of it very early. I sold half, I think, at 60s to de-risk my portfolio position. Now it's all profits, but I don't think I'm ever selling unless the thesis breaks. Like, I truly believe this is a $1 trillion company in the making. I don't know when that hits there, but knowing that AI has an untapped ceiling, this is the stage 2 AI winner. And there's a second name that joins that list, and we saw their earnings last week, Cloudflare. We won't talk about Cloudflare much, but Palantir, I think earnings, if there's a dip, I can see that, because you're seeing Netflix 60 times earnings dip after strong print. You saw Cloudflare 130 times EBITDA dip after being up last week. Palantir, I can see probably being down 5%, but there's a very high floor in any kind of dip in Palantir, just because of that stage 2 AI moat that they have that everyone wants a piece of.
Steve, I want to tap you and just talk about zooming out from today and earnings today, the trajectory of Palantir. And I know you have this concept of a earnings inflection strategy, and Palantir being one of the companies that you cite that fits within that. Can you explain what that is, what you're looking at, maybe some other examples too of companies that fit that pattern that you've identified?
Yeah. So again, love to share some charts. Basically, indeed, so at Bloomberg indices here, we create systematic, equity indices among others, and this is a concept I've been working on a lot recently. I'm quite excited about. I'm calling it reformers or earnings inflection. The concept is basically as follows, right? Companies, can go through a tough time. They can be losing money, but when they make improvements, when the fundamentals turn around, you rather want to be there in the beginning when that inflection, that sort of turnaround happens than later, because when that turnaround happens, from with stocks that are oftentimes abandoned by investors who are looking for quality, profitable companies, you can actually see a very dramatic asymmetric re-rating. And a good example is Carvana, right? Carvana went from over $300, during COVID bubble, crashed to almost single digit. People thought it was going bankrupt, and it has now roared right back to all-time high, even already all-time high. And the question is there a way to systematically identify such behavior? It turns out actually there is. If you track fundamentals of a company and you intentionally screen for companies that are money losing, you can actually have a scenario in which the company sort of starts to develop improvements. You can calculate essentially like a trend score, right, on the company's fundamentals, and hold the company as long as it continues to make strong improvements. And this is exactly what happens with a strategy like that. You see the blue areas when the strategy systematically picks up a stock and holds it, right? Shay, you look like you might have a question.
No. I'm seeing some examples of that. I'm looking at.
Yeah, and another example is Palantir, as we were talking about, and this strategy pretty much picks it up exactly at the bottom. So in the market, there's always narratives, but then there are fundamentals. In my opinion, fundamentals narratives are always fundamentally about fundamentals. They're confirmed by fundamentals, right? So in this case, Palantir was money losing for a long time. The stock was actually going down, but underneath it all, the fundamental has actually been improving, right? Net income been rising and operating margin been rising, and they actually reached net profitability sometime in 2023. And if you look at that stock price, the red line, that's exactly when it started inflecting and rising vertically almost. So basically, these are really just examples of such instances of what I call earnings inflection. Companies that are money losing less money, and we have seen so many different examples of such. Like Robinhood is another one, Uber is another one. So it's pretty interesting that
Yeah.
it works more than just tech companies as well. That if you look at energy companies, and in 2022, this was exactly what the strategy was doing, and it's showing you a similar thing, right? Energy sector was coming out of COVID and money losses, and as it was making its way back towards profitability, the inflection, happened with fundamentals and also with the stock price, and that's instance and also why this, systematic strategy did not have a big drawdown, had a much smaller drawdown than the overall market because it was autonomously rotating into sectors that is showing this pattern.
And how many, when you're looking at that inflection point, like how many
Yeah.
quarters of losing less money would need to happen to make that trend? You wouldn't want to necessarily call it for one quarter, I would assume, but how do you
Mm-hmm.
think about that?
So we look something along the lines of like 4 trading quarters and a couple quarters ahead, right? To looking at estimates, and you calculate essentially like improvements, right? And the idea is that you want to intentionally screen for companies that are already money losing, and also have been making improvements. So by construction, if a company is currently money losing and had been improving, it must have been losing money for quite a while. So the trailing 4 quarters plus the coming quarter, like sort of generally, you're looking at a company that's money losing for a while, but then also making improvements, sort of for a while. So that's how we look at it.
Yeah, and I want to now. This is good pivot. And I know we have a lot of bigger topics we want to
Yeah.
get in with you, Steve. On the topic of improvements,
Mm-hmm.
you've written about analyst ratings improvers. So
Yeah.
companies that Wall Street had written off for dead, but then they start getting upgraded again. So similar sort of inflection in
Mm-hmm.
moment. How do you think about that sort of mental model when looking at these companies that might be poised to turn around for investors?
Yeah, I like this idea a lot of sort of improvements, right? It's very much like America, second chances, right? And there are different ways in which companies can improve. You can have a young tech company that's money losing and losing less money, and that's what we're seeing with this earnings inflection. But you can also have older companies, cyclical companies that's going through its own sort of cyclical improvements. You can have things such like Hershey, they will go through some sort of structural struggle and come back. And analyst rating improvements is similarly, we exclude companies that are analysts telling to buy, right? And we look at of those that are not being recommended as buys, how many are seeing their ratings improve the most. The idea is to buy companies that analysts hate, but don't hate quite as much as you used to. And so you sort of pick up the early improvement trend before it becomes consensus. So it's a similar idea. Except there, you tend to pick up older companies, value companies that is improving through cyclical turnaround rather than something like Palantir or Carvana that's going through a different type of I guess cost discipline, or maybe the top line business thesis proving out.
Interesting. Yeah, a lot of these models are, it's almost you're getting not under the radar, but not the most extreme cases of either hatred or hate or criticism. It's sort of like who's kind of, like people don't love them, but they're not the top headline. And then you zoom in there, which is interesting.
Well,
Go ahead, Shai.
now I want to make some commentaries on that because like it's great insight, Steve. I appreciate it, and also I think it's really important where finding the alpha before the FOMO kicks in, and I think that it's people think it's very easy. Like, people think like Palantir is easy to invest in Palantir, making an overweight position 4 years ago, 3 years ago. It wasn't. Do you know what their label was? Black box consulting company that will never touch the commercial space because
Yeah.
of the voodoo magic that they're assigned. People thought it was just malware. It was not a real company. Clearly didn't, but a lot of people did. Now it's stage 2 AI winner. Everyone wants a piece of it. Guess what? It 10x already. Maybe even 20. It 20. No, it's 10x. Now it's valuation profile is different. Risk and reward profile is different. That's one case. Second case, Rocket Lab. Everyone viewed them as just a launching company for years. You had the chance to get Rocket Lab under $5 for over 2 years. People thought, why bother? SpaceX, like SpaceX is clearly the king of launching. Rocket Lab is just going to be the unwanted child in that family of space launches. Well, people didn't really track that they're building the space logistics company of the whole 1.8 trillion dollar economy. That's not just going to be SpaceX, because guess what? If you're a multi-trillion dollar economy, you can't just have one company. Oh, spoiler alert, there has to be multiple players. And this looks like there's going to be a duopoly with the acquisitions that Rocket Lab was doing. And now it got re-rated. It's not just a niche launching company. It's potentially a full-end space prime contractor.
How much do you
And
think Rocket Lab's recent fortunes have to do with Elon's falling out with President Trump?
the last 2 months for sure, I think that's what
Uh-huh.
caused it to go from 35 to
Yeah.
50 plus. But I do think that it's providing more spotlight onto Rock Lab,
Mhm.
seeing like all the offerings that they have now. And I
Mhm.
think that's what helped probably maintain why it's staying such a high floor on this like squeeze up. But that's another example. Another one is CrowdStrike. Like we talked about
Mhm.
this. CrowdStrike,
It's actually my
they st-
personal favorite and my largest holding in my
yeah, I
personal
love it's
portfolio.
a top 5 holding for me, but like everyone,
Yeah.
they stopped the world from working for a couple hours, and everyone's like, they're gonna go to zero. They can't afford all the lawsuits coming their way. When
Yeah.
guess what? If you look into the contracts, they're actually capped at how much they actually pay
But that's
their
that's interesting,
customers.
right? CrowdStrike is actually a good example of running a little counter to what you had said earlier about hyperscalers creating applications that will kill off the specialized
Hmm.
softwares themselves. Because Microsoft tried very hard to basically kill off CrowdStrike and never could, right? Microsoft's
Hmm.
own version of
Of
antivirus,
endpoints, yeah, it's great.
that's right.
Yeah.
And it
Hmm.
turns out there is actually, CrowdStrike is AI driven and it's end to end apparently, and there is actually still returns from specialization. What I suspect is going to happen is that you can have a sort of a multi equilibrium where, a lot of the not very high value add software will get driven out by the agentic, implementation. But then you will
Hmm.
have specialists, right, who will provide value that is not easily replicated with a agentic, on-demand software, such as CrowdStrike. I think that's a good example, right?
No, you're absolutely right on that. And also, I think cybersecurity is very unique because it's going to
Mhm.
grow adjacent to AI. It won't
Yeah.
just be
Well, the market
scooped
has
up.
been made much bigger. The TAM got much bigger with AI
Huge.
because AI feeds the enemy as much as the good guys, right?
Exactly. I've been saying that the new battlefield is above your head, not in front of you anymore. And I think that
Yeah.
drones are going to continue momentum. And guess what you need with drones and autonomous systems? Cybersecurity. Like, it's going to be so like every growth theme of hardware is going to require more cybersecurity. Optimus robots, robotics. I'm telling you, like, if there's millions of Optimus robots out there, I promise you that cybersecurity is going to be even more important, because if someone hacks these robots, like, I'd be scared. Terminator 8, 5 might be a real thing. So like I think that cybersecurity is like one of the safest. It's like the area you can be defensive and offensive at the
Hmm.
same time for risk on. And I think that there's only a handful of tier 1 players out there. It's highly fragmented. So like if you try bottom fishing cybersecurity names out there, like a cheap like Sentinel-1, for example, it's really undervalued, but it's not going to survive the AI tsunami because they have a CrowdStrike problem. And the biggest fumble I've ever seen what CrowdStrike did, they still were not able to capitalize on that. That showed the moat that CrowdStrike has, and I think they're going to get acquired some bigger player out there. But either way, I think cybersecurity, if we're fortunate enough to get a pullback in next couple months, don't have cybersecurity exposure. That is one of the themes I think you absolutely need to get exposure in. And Palo Alto is maybe giving the opportunity right now. It's down 25% post CyberArk acquisition. They're one of the tier one players. And yeah, I want to add some color to what Steve was saying.
I do think there is some interesting themes underneath all, right? The one idea is the idea of network externality, that you benefit from on large network of users. When CrowdStrike brought the planet to a halt with and all the airplanes and so on, and when they didn't die and lose customers, that probably became the validating moment that they are probably quite
Yeah.
indispensable. That
Mhm.
CTOs probably have a hard time, replacing them. But more broadly, I think this speaks to the success of why all the mega cap tech companies command such high valuation. Is really they benefit from their dominance in the real economy, right? They, you talk about all the Max Sevens, like these are companies whose products we have essentially become so reliant upon that we cannot live without them, and their products actually are better because of the network of users that are already on their user platform. So that's one theme. And I think another theme that's emerging that's quite interesting is actually geopolitics and national security, critical national security demand, right? So you look across the landscape, whether it's AI, whether it's space, whether it's cybersecurity, there's a sense in which every country is looking for its own solution because of the geopolitical concerns. Uh, and I think, and now we're seeing that also in natural resources, rare earth
Yep.
being, a critical, a point of attention between U.S. and China. So it is, certainly, very interesting to watch, how these
Mhm.
different names actually are proving, affirming the underlying, thematic thesis.
Mhm.
Yeah, I mean, I think that's interesting because we do like that again. We talk. There's headlines out there and talk about the Shy talks about the AI tsunami and SaaS, but it is kind of. I feel like AI creates sort of like an 80-20 rule on steroids, where winner really does take all. And so I'm curious, even when you guys were talking about cybersecurity as one adjacency to AI that will benefit, what other pockets might be outside of cybersecurity. I haven't really. I don't know if you guys have put much thought into that, but um, I know Shai, you've talked about, CRM's one place being like, okay, that's an easy, easily disrupted pocket. What are the pockets like cybersecurity? It's an interesting thought exercise for investors. I don't know if you guys have any concepts there. If
Yeah.
not,
Well, no, no, I could.
yeah,
Like, who else will be victim of the AI tsunami?
yeah, or
I
like
think.
the other way, like who's like a CrowdStrike in this case? Like, what's cyber is more
Oh,
important
oh.
with more AI. Like, what's the and
I
that's
think.
yeah.
I think. Regulate anything that has compliance or regulation moats is going to be safe because that's why Oracle's doing such a great job on leveraging their database mode on governance essentially by capital, and now they're in data centers now, and that's a
Mm.
huge tailwind for them.
And
IBM is another great one that nobody's talking about. Like they have 70% of all financial transactions is through their mainframe. That will never change. So once AI is whatever AI does in the transaction realm or financials or banks, they're going to be a major beneficiary off that because nobody can compete with their mainframe, and none of these banks, etc., will leave that as well. Uh, before I talk about the victims, Steve, you had something to talk about
I
that?
think beneficiaries probably another one. Going back to what we were saying before, Tesla likely benefits from its large network of fleet of cars and also data gathering. Right, it's kind of a virtual cycle where again it's network externality. Right,
Mm-hmm.
the reason Tesla FSD is number one, it probably has to do with the fact that they have had the biggest fleet of their own cars driving around the road collecting data on which they are training the AI, their algo, which makes their algo better, and that creates a competitive mode in the age of AI. That how all has to do with scaling. So whoever gets that first and starts to scale first, you are sort of staying
Well,
ahead of the pack.
well, I think also whoever controls the whole stack. I think that's why you're seeing like Zuckerberg, for example, he's throwing money at the problem they had because he could not get the llama quality up to standard, or that improvement that we saw from Grok 3 to Grok 4. He was not able to do that in the past 6 months for llama, so he has to acquire scale AI because the reason his llama was subpar was due to data labeling. Like it was just not good at data.
Quite honestly, guys, I'm still puzzled. Who is using Meta AI? Do you guys use Meta AI?
It's open source. That's why, because like we don't use it. I think it's
Like,
more of a
like the thing
scaling
is, but
thing.
he's claiming there's all these active monthly users and so on and so forth. I mean, accidentally, I click on the WhatsApp, AI thing,
And you're a daily user. That's what he's. That's probably what he's using.
That's what he did with Threads. Like it's just
Yeah.
like that's a playbook, right? Like you
Yeah,
open it
Yeah.
once.
those
I'm
those
a
numbers are
Threads
fugazi.
user,
Yeah,
you
those numbers
know.
are fugazi.
I,
But
like the thing is, I use ChatGPT every day between ChatGPT and Gemini, and sometimes I used to use Anthropic for coding, Claude, but not quite as much anymore. I don't even know where I go if I want to say use Meta AI for coding.
well,
I
well,
don't I don't either. This is a
here's
great
the
question.
thing, though. Remember, like one of the 4 things is requirement is distribution.
Yeah.
Half of the world uses Meta products.
Yeah.
So if they can just get Llama to the certain points where
Yeah.
it becomes that connectivity tissue on all their products, I think they have a distribution thing that nobody else can match, and they're going to be
Speaking
capitalizing
of
and leveraging that.
distribution, what's going on with Apple? Like, I'm really disappointed. 2 years ago, I really thought Apple was going to be one of the biggest winners because they have distribution network through the iPhone. They can just turn it on, right? I thought
Yeah.
they would just go and buy a lab and get to state of the art and distribute. But
Well, they have an urgency problem. Like what? Like
yeah,
they've been so comfortable for decades, and their leaders have not really left. They've been in the same position, so like they need a new culture change. Like they need AI talent to come in the house to ruffle a few feathers. Like stop relying on your services revenue. That's a cash cow. Incredible. I some like great job, guys, on like going from hardware to become this like service player. That was incredible. But they're just so comfortable that they think that they can like they don't have to accelerate their pace when they feel the need to. They'll like I think they are feeling the need to. By the way, Tim Cook's very much more vocal now with their AI strategies. I think we're gonna see a pivot on narrative in the next 6 to 12 months for sure. The jury is out though, is if it's too late. And if so, they have to acquire their way into becoming this AI player in this super intelligence race. And you just saw the price tags on just one talent. It's like $200 million. And I do think Apple has to pay a premium though, because there's a real thing in the talent pool where they want to work with revolutionary leaders. Zuckerberg, Sam Altman, Elon Musk, like they don't have to pay a premium to get people to work for them because they're these AI brains. They like, I'm gonna learn so much from working close with these people that I can't say no to the opportunity. If you work at Apple, what you're gonna work with all these dinosaur people who don't know AI? Like you feel like you're gonna be coasting and wasting your time. You're gonna have to go there for money, and now Apple's gonna have to probably pay $250-300 million compared to Meta having to pay
That's the
200 million.
ideal situation, right? Because it's not just they need the talent, they need the press release that says they got the talent. And so if you're in the negotiating chair, you're like, hey, you're a big name in AI. Like you guys need to be able to not only have me, but say you have me to stop sort of the public bleeding. And yeah, in the earnings, we've talked before, Steve, on the show, we talk sometimes about culture at Apple being more prone to build versus buy, but we had some comments from Tim Cook last week indicating, they might need to start some M&A activity on this front.
Well, here's also the thing, like OpenAI, like one of the 4 pillars, like I said, one of them's distribution, probably the most important pillar. OpenAI does not have that. I don't know if they ever will. How do you get that? What does Apple have? The only one of the 4 pillars that Apple has, maybe you can argue data, they maybe have 2 of the 4, is distribution. So I do think there's going to be a world where if Apple can't figure it out, there's going to be some kind of massive merger of powers for $400-500 billion at a minimum. And this only happens if Tim Cook feels the heat and potentially has to get fired, and the board of directors want a product-oriented CEO in place. Nobody's better at product-oriented in AI than Sam. And I just think that it makes too much sense. I don't think it'll ever happen, but it's just an example of if Apple acquires their way to their AI race, you have to find a company who doesn't have that distribution pillar, but has the other 3 that's required. And that's how the synergy works. Maybe it's Perplexity. I think Perplexity is very niche on their model quality. It's primarily for finances. That's like Bloomberg is kind of their niche of trying to compete with. Steve maybe has some more commentary on that. Maybe he can't talk about that, but I just think that they're very good and very Bloomberg adjacent. I don't know. We'll see.
Yeah, it certainly seems like a very missed opportunity for Apple. I really thought they were going to do something a couple of years ago when they abandoned the car project, and it was obvious that the headset was not going to take off, in a big way. But I don't know what explains the last couple of years. I think Apple does have deep down a cultural aversion towards acquisition, and they prefer to do things in house to look the Apple way. And they've always been afforded the privilege of going later because they have this sort of loyal user base, millions or millions of the highest paying, wealthiest phone users that I can just turn on. So I still think they have a pretty tremendous distribution, advantage, and eventually the competitive landscape of foundational model is going to consolidate further because they have to make money, right? And right now the revenues are growing, but the profits are not really there. Um, but meanwhile, these things are extremely capex heavy. So I think Apple still has a bite at the apple.
Well,
Just it's gonna be a little more expensive.
Well, I also one because I don't think we talked about Apple earnings release because we didn't have the pod on Friday. But I think that that was one of the most misleading market reactions to that earnings because it was
Front
not
running.
strong. It was front running.
Mhm.
It was discounts on China sales that caused iPhone sales to go
And
up.
tariffs.
People anticipate, tariffs tariffs will come in, so they vacuum demand on iPhone sales. So that iPhone narrative that people's like, oh, it's actually doing better than expected, ignore that. That's so false. Services, I agree. Service revenue is like all time. It's doing great.
Yeah.
I'm part anecdotal evidence. One of my AirPods didn't work just 2 weeks ago. I had to go buy brand new AirPods. I think all their services or every revenue for them is just based on something a little broke. I have to go buy it again. I
Yeah.
don't think it's anything innovation front, and that's a scary place to be in
Yeah,
as a
Apple has
company.
never really had a very strong business in websites. They've never had Apple TV. Maybe their most successful services product,
Mhm.
right?
Yeah.
Generally speaking, they've always sort of been more on the hardware slash on hardware software side, and how much they struggle with Apple Maps. So it's interesting. The strategic position they are in. They're gonna have
Well,
to make a strategic pivot.
Well, maybe in 10 years, we won't even care because they're going to acquire Figure AI and they're going to have every Apple robot in every household. And that's the
Yeah,
next hardware lever they're going to pull. It's
yeah.
so obvious. Like phones, smartphones, robots. That's the next hardware that they can capitalize on their 2.4 billion devices that moat they have. But that distance, who knows when that ChatGPT moment happen for robots? Their moat might get demised by then, and OpenAI and Janie Ives might create this like competing product all of a sudden. And now they're not a monopoly as much anymore.
Speaking of front-running tariffs, I did want to show you guys something that I think you might find interesting.
Let's do it.
It's actually uh, this guy, right? I created what I call a tariff factor by using the event or of the 1 week window around Liberation Day, and I just calculated a market return adjusted return of all the stocks, right? And I sorted in them into five baskets, right? Five buckets of equal number. And I take the top bucket and subtract the bottom bucket. The top bucket are basically tariff beneficiaries, companies that actually do better, right? When tariffs are put in. These are companies that tend to be more software, driven, not, subject to tariffs. And also companies have already had a substantial amount of production happening domestically and revenues derived, within the US. And then the other way around for the losers. And what's interesting is that tariff, actually, if you can see in this chart, has actually been driving the market way before Trump was reelected and continues to be obviously that big jump during Liberation Day. And we're looking at what has happened since, right? Since the sort of the relaxation, of some of the, tariff news, what people sometimes call taco, right? You see this sort of wiggly line, but overall we are still very much within the regime of the geopolitical tension, and to which the tariffs really is a response.
Interesting. It's
I mean,
interesting. Yeah, go ahead.
software was a safety blanket
Yeah.
in March and April. Like it truly
Hmm.
was. It's something that they have no debts, so the interest rates mean nothing to them if it has to
Hmm.
stay higher for longer. International you'd be surprised of how behind internationally. A lot of countries are on
Oh,
software,
absolutely,
AI,
yeah.
and tech. It's like not really a thing yet.
I mean, Japan
Uh,
still famously operates on fax machines, right?
no, it's no exactly
Wait,
like
what?
they're very cult. Like there's
Yeah,
a lot of
fax
these
is a
places are
big
cultural.
over
Yeah.
there. Yeah.
I mean, that might be the most secure way to send documents, though, if you think about it. Maybe that's intentional. I know we're coming up to the end of the hour, but real quick before we leave, Steve, what did we not talk about today that people should be thinking about or paying attention to?
Well, so of the things I've been watching, really is I worked on stuff on pricing power from a couple of years ago when inflation first became a thing. I'm trying to understand sort of where pricing power comes from. I think that remains to be a big theme, right? So in an era where countries are all trying to bring manufacturing home and through the use of tariffs and more trade tensions, the ability to pass on costs is going to become quite apparent in the cross section of stocks. So that's what one area, and another area that I think that's worth focusing on. There's something I'm paying a lot of attention to is how to think about investing within a geopolitical framework. Right, we are in a geopolitically fragmented world now, and stocks and companies can be valued for reasons other than their intrinsic, purely economic reasons. Right, in the limit, economics is politics. So I don't know if you ever heard of a company called MP Materials that has
Yes.
Yeah.
been a little bit, and it turns out that company is in the news because it's actually one of the few, if not the only companies that has solution for rare earth production. And I think DoD became a shareholder, and then
Which is
Apple signed up.
unprecedented. That never
Yeah,
happens in a
Yeah.
publicly traded
yeah,
company.
right.
So it's crazy.
And this highlights, I think, basically a core tension that the U.S. and China are going through something along the lines of a strategic divorce, right? And that's not, I think, a secret to anyone. And while they are talking, because each side has a insurmountable stranglehold over the other, that they cannot just sort of outright divorce. They are sort of preparing on each side sort of ways of overcoming that stranglehold. And in the U.S. case, it's basically China's dominance over rare earth mineral supply, which is used in practically everything modern, from robotics to EV to everything else. I'm sure she can speak to much more comfortably.
Yeah, I think we got that trade deadline coming. I think on the 12th. If it doesn't move again, it's a little over a
It's
week.
always in 2 weeks.
I know. I'm like, oh, the 12th.
I
Shy,
know
how about you?
there's a meme out there. The year is 2050. The tariffs got moved 2 weeks again.
This does go back to something we touched on, where it's like in the current landscape, whether you're getting memed or whether you're the head of the BLS stats, there's just things are moving at such a pace where like you could wake up one day and be the main character of the stock market for reasons like you were not prepared for. And I think I think it was a Bloomberg article talking about like what to do if you're the CEO and you wake up one day and you're like American Eagle, was one of these, but it could be due to like this
Is it
geopolitical. It could
American
be,
Eagle, Sydney Sweeney?
yeah.
Yeah.
We're already past that apparently. I think that's last week's news, but you could be like, oh, the marketing team did something, and then you open the paper or whatever you read, and you're like,
Well,
holy.
Trump just tweeted 10 minutes ago about it.
Oh, of course
Again.
he did. Yeah, I don't. Of course. Shy, any parting words from your side? I know you got a busy day tracking everything that's going on in a 30-year portfolio, but I'll let you have the final thought.
Yeah, I mean, I might be really happy or really miserable tomorrow morning. You guys will see.
We'll see.
I think, listen, the market's like bouncing hard right now, and I think that's beginning of the show. I was like, I'm surprised the market was still red on Friday because it's the world's worst kept secret. These job numbers are fake, and not just that, odds doubled on a September rate cut, so all eyes are on that. That's more of a weight on the market than, I don't know, potential recession. Unfortunately, that's just the way it is. So I'm not surprised to see that. That combined with the earnings have been very strong from the big tech players. Like not just top line growth, their earnings expansion is ridiculous right now on their estimates. Like it feels like an inflective quarter on. You're seeing an actual ROI on AI now because these earning beats are just bonkers. And I think that provides a very high floor in any pullback. AI is still the main show. Whether or not Powell wants to admit it, rate cuts are coming. Those two factors alone are just going to drive the market. There might be some seasonality weakness. I get it. September, August, it's just like an ugly time, but it's also everyone knows that. So it's really hard for me to believe like we're gonna get a big pullback when everyone knows right now, next like 6 weeks, 8 weeks, it's going to get ugly. Usually pullbacks happen when everyone does not
It
expect it.
seems that everyone is already anticipating some kind of ugliness because of
That's what I'm saying. Yes.
seasonality, right? Between
So it
August
feels
and
too
October.
easy. It feels too easy. So I don't think it's going to happen. But if it
I
does,
think I
I'm
read
prepared.
Mike Wilson saying that he was expecting a 10% pullback, but then he'd be buying, the dip, and
And
see
he's
a
the biggest
rollback.
bear. Mike Wilson's the biggest bear too, and he's saying that. So anyway,
Yeah.
be cautious out there. Don't get greedy. If you're freaking out on Friday, that means you're over leveraged. You have too much invested. That's a great sign of like if there is more pain to come. I don't think you can take it. So take some chips off the table. Be prepared for any pullback. If not, worst case, it goes up to the right and you're not losing anything. You're still making money.
All right. Well, we'll have some more news to share tomorrow. Steve, thanks so much for popping by. Thank you for bringing your charts. Guys, go follow Steve. This was fascinating stuff. You'll have to please come back and see us again. This is great.
Thank you so much for having me, guys. Really
All right. We'll
enjoyed
see
it.
everyone tomorrow at 9 a.m. Eastern right here on the Daily Rip Live.